Hey guys, Drew Rice here, and welcome to the Engineering Success YouTube channel, where every week I talk about personal finance, investing, and other money-related topics. Today I'm going to tell you about 6 different travel and leisure stocks that I have been investing in and am looking to continue adding into my positions during this downturn in the market. And basically I just want to share those ideas with you guys. Definitely don't just go out and buy these because I talked about them. Do your own research. I want to share my thoughts on them and at least give you an idea of what I'm looking for to invest in a market like we are experiencing right now. So let's get started with the list. To start off, it helps to understand why I'd want to be looking in the travel and leisure industries for investment opportunities right now. And that's because that's what's been hit the worst. Out of everything, the entire market is down over the last month to 3 months, but travel and leisure has been just smashed with what's going on. And it makes perfect sense. People aren't wanting to travel. There are different bans on whether or not people are able to travel. And you know, when you don't want to be around other people, the last thing you want to do is get on an airplane, a cruise, or go to a hotel. And so that's why I'm looking in this area, because I think that a lot of these companies are very good companies that will last throughout this market downturn, but that they are right now very heavily undervalued. So the key thing I'm going to be looking for is companies that are a good, strong, long-term company, but that have low debt right now, because that way they'll have a better chance of handling the lack of cash flow during this time of uncertainty. The first two that come to mind are airlines and cruises, because those are the two that have been hit the worst out of the travel industry as a whole. And honestly, for me personally, I know a lot of people really like Carnival Cruise Lines. I'm not touching any cruise stocks. I just don't see the risk reward there. So I'm not really putting any cruise lines on here because I just don't see how they're going to be able to survive without a bailout. I know they're getting help through loans, but those are very high interest rates and they may come back, but you know, I also don't really want to bet on companies that are not even American companies. I want to look at companies that are strong American companies that will last long term. So with that disclaimer out of the way, let's look at airlines. So for airline stocks, whenever you're looking at those, the two big players are always Southwest and Delta. They're definitely the biggest market cap companies in the airline industry. And out of those two, Southwest and Delta both look like great long-term companies. Southwest has less debt than Delta does, but at the same time, Southwest has not dropped near as much as Delta, so there's a lot more of an opportunity with Delta because Delta's dropped 62% in the last 3 months, which just it getting back up to its 3-month high, you're looking at 180% return. Whereas with Southwest, you're only looking at about an 80% return. And I view those two companies as about equal as far as their long-term potential of making it through this and growing afterwards. So let's look at Delta. So currently Delta's in the 20s and it was as high as in the 60s in January. When I'm looking at it, the main thing I look at with Delta is their PE ratio is 3.1. I mean, that is a joke. I understand that right now they're not making, they don't have the cash flow that they normally would have, but the market average PE is 15. So generally speaking, when I'm looking for investments, I want PEs that are below that 15 mark unless it's a, fast growing company. I personally don't view the airlines as fast growing, so I want that to be below 15. And when you're giving me Delta Airlines with a 3 PE ratio, I'm going to have to at least nibble some of it, and I'm going to have to pick up some of those stocks. Now, the one thing you'll look at is their debt is 76% to asset ratio, which a little on the high side, but within the airline industry, because that's a very high debt industry, it's pretty good. I mean, comparatively speaking to American that has over 100% debt to asset ratio, that's too risky for me. I'd rather go with Delta. And then also Delta has a good, granted short history because they've only been doing it for about 5 years, but Delta does give out a healthy dividend when it's in a good economic situation. They are still giving out a dividend, and that dividend is up to 6.6%. And that dividend safety score is actually really good because their dividend payout ratio is actually 22%. So it's a very safe dividend normally. The one thing is, I expect them to not pay out that dividend for the next several months and maybe even the next year. But I know that holding this long term, this is a really good price point to get in and be building a dividend earner long term. And This is the lowest stock price they've had since 2014. And anytime I see a good long-term company at, over 5-year lows, I'm going to buy some of it. My concerns with Delta, though, are limitations on stock buybacks in the future might actually hurt their ability to get back to that 3-month high. However, I still look at them as an over 100% opportunity, so it seems like it makes a lot of sense for me. The other airline that I think is a really good value and is not as widely talked about is Spirit. In the past, I hadn't looked at Spirit as a great buy, but right now it's dropped 75% in the last 3 months. It's only a $10 stock, so if you're someone who's just getting started and you aren't using fractional shares, this is one where you could, add some each week. Even if you're only putting, $50 or so in the market, you could be picking up several shares of this, which is a great place to start investing. When you're looking at the P/E ratio, again, it's so low, it's a joke, like 2.1. That's insanely low. The debt to asset ratio is 68%, which is lower than Delta's, and fairly reasonable considering an airline. And the biggest thing about Spirit is that their CEO came out saying that they aren't going to need any bailouts, that they're going to be fine because of being a discount carrier, that they're used to having to adjust in vast changes in volume and downtimes. So I'm looking at that as, that seems like a pretty undervalued buy and a very safe bet within a very risky industry. I will say another one to look out for is JetBlue. JetBlue is very similar financially to Spirit. However, I didn't really want to go with that because of them being a New York-based hub. I feel like they might be reeling a little bit more based on the situation that's currently going on. But all said and done, you're looking at Spirit as a possible 350% return if it gets back to its 3-month high. That's an insane opportunity there. So I've been buying Delta, and that's a much bigger position that I have, but I am adding more and more Spirit now that it's down at a very attractive price point, and I see that as a pretty good opportunity within the airline industry that isn't talked about much. So for the next category, I want to talk about hotels. So most hotels I'm not very interested in because, again, I'm looking for low debt to asset ratios. Most hotels have high debt to asset ratios, and we're talking in the 80s to 90%, and that's generally just not something I'm interested in, especially in a time where there's not going to be much cash flow over the next several months, most likely. Well, within hotel industries, I did find one that I think is a pretty good opportunity, and that's Hyatt. So currently Hyatt has gone down 55% in the last 3 months, which means that we have an 135% opportunity if it gets back to its 3-month high. It's currently trading right at $40 per share. Its P ratio is only a 5. So by comparison, we're looking at, say, Marriott or Hilton that have 80-90% debt, and those have P ratios that are over 10. To me, this is such a steal. I just don't see any better value within that industry. Their debt to asset ratio is only 50%, and they pay a dividend. Granted, it's only 1.89, and I don't expect that dividend to last over the next several months. I do think that they are definitely going to cut that, but it's still something that shows you that they're looking to reward investors long term, which is definitely something that I'm very interested in. And also, just from my reference point, I know that whenever I travel for business, my company and a lot of the people that I know that work as engineers in other tech-based companies, or companies tend to have deals with Hyatts. And I think that that's one thing that really helps them, comparatively speaking, to a Marriott or a Hilton. Those higher cost hotels are not hotels that businesses are going to want to use, but businesses tend to lean towards Hyatts, which I think is very good for them because I think that business travel is going to come back much before average consumer travel. So I think that they'll have a better chance of getting some more cash flow sooner. On top of that, I just love Hyatt. I've always wanted to invest in Hyatt. When I first moved to California, I actually was put up in a Hyatt and lived there for about 3 months with my company. And I have nothing but good things to say about Hyatt. It's a great company. I see it as a great value. And if I'm going to invest in a hotel, this is the one that I have been investing in. And definitely check it out. It seems like a good opportunity to me. Okay, so this one might be a little bit of a boogaboo for some of you, but the next section I'm looking at is casinos. So whatever your opinions are in casinos, I'm not a gambler. I don't even play the lottery. I've never bought a lottery ticket in my life, but I they're cash machines. The reality is that when I'm looking at the difference between an airline and a casino and a hotel, and I'm saying, well, which one's going to be able to turn around faster once the economy does start getting going again? To me, there's just no question that a casino is going to be able to do that quicker than hotels or airlines, where they have so much expensive equipment that they're having to maintain during that time. Granted, casinos do have properties that they have to maintain. It's nothing compared to the massive fixed cost with airlines and cruises. Also, I think after being stuck in our apartments for, who knows how long, I think a lot of people that do enjoy those types of activities are going to be very, very ready to get out there and, have some fun and, just not be inside their own home. But overall, casinos have been hurt a lot short term. I mean, we're looking at, them down 70, 80+%. I mean, they've been hurt as much as, if not more than the airlines, depending on. A lot of that has to do with, their two hubs being Vegas and then Macau in, China. It's like, they were already getting hit in January and February with their Chinese operation, and then now they're getting slammed with their U.S. operation, and it's definitely a bloodbath. But when I'm looking at different casinos, there are two that jump out to me. So the big three are Wynn, Las Vegas Sands, and MGM. And out of those three, I personally think that MGM is the best opportunity. It's dropped 70% from its 3-month high, and if it just gets back to that, we're looking at a 250% return, which is absolutely mind-boggling. Then on top of that, it's only a $10 stock. Again, it's one that anyone is going to be able to invest in without fractional shares, so it's a good place for you to start if you're wanting to buy shares consistently. That's one that you can add in even if you're only investing a little bit. The P ratio on it is 2.9. Again, that's a joke. If you're a P ratio with a company that's long-term profitable and looks really good to me, if it's under 10, my mouth's watering. If it's under 5, we're talking, unless this company is just completely destitute, there's no, it's a no-brainer that I should invest in this. Under 3, I'm gonna. And then their debt to asset ratio is only 62%, which is great. When you look at Wynn Resorts, which is their big, the one that the pie in the sky that everyone really wants, and that's the one that everyone wants to invest in, it's a casino, not a tech company. Its PE ratio is over 10 times this. I would, to me, this is a steal. The one thing to keep in mind is when comparing this to the big 3 international casino brands, you have Wynn Resorts, Las Vegas Sands, and MGM. And out of those 3, MGM does have the largest percentage of revenue coming from the United States. That is the one big hiccup is, while these others are hopefully recovering business in Macau, China a little bit earlier, it might be a little bit farther behind. However, again, I think that debt ratio is really going to be its saving grace. I think it's going to be able to weather the storm. Also, in comparison to the other casinos that are not Wynn and Las Vegas Sands, I like the fact that they have exposure in Macau, because this means that, in my opinion, it's going to recover more quickly, because as soon as the US bans are over, hopefully there will be over in Macau and in other places, and people will, they'll be getting cash flow in those areas that will help them to get even farther. And then the other casino stock that I've been buying is Eldorado Resorts, which is ticker symbol ERI. And that one, it's a little bit riskier than MGM in my opinion. It has dropped more. It's dropped 83%. It's got a nice hefty payout of, 600% if it goes back to its 6-month high, which is absolutely insane. But when I'm looking at it, again, the P, it's a $10 stock again, so same story as MGM. Its P ratio though is a 10, which is a little bit high. It's still undervalued, but a 10 is much higher than a 3. So, when I'm looking at those, I think MGM's not as hyped up. That being said, more opportunity with ERI. The debt to asset ratio though on ERI is 80% compared to the 60% with MGM. So a little bit more debt, no long-term plans for a dividend with ERI, whereas there is a small dividend with MGM normally, but right now it's at 4.5%, which is good. However, they're going to cut that. There's no way they'll keep paying that over the rest of the summer, in my opinion. But either way, ERI looks really good. The one issue with ERI is that it is a all US based casino. Now it is buying Caesars. That's the main reason that I'm looking at this as a good opportunity, is because once it buys Caesars in June is when it's scheduled to occur. Once it buys Caesars, it'll be the casino with the most US market share, which I see that as a good growth opportunity compared to, MGM or Wynn. And so that's why I really think this is a good opportunity, is because worst case, you should get a merger bump in the middle of the summer. That should help. And, I just think they're positioned for long-term growth better than Wynn or Las Vegas Sands, but a little bit riskier than MGM. So, I'm buying a little bit of both MGM and ERI. And then lastly, so this is my best all-around pick for travel and leisure. And this is the one of these that I'm buying the most of by far. And that's because this is the surest bet, and it has growth too. It's not just, I'm not just hoping that it gets back to where it was. I'm hoping that it continues to grow throughout the future. And that is Disney. So everyone knows who Disney is. They're an extremely well-diversified company. They have the streaming service, they have ESPN, they have other broadcasting services like ABC, obviously the Disney services themselves. They have cruise lines, they have parks, they have merchandise. They are an absolute Goliath. And right now they're down 40%, so they haven't dropped as much as the others. So, maybe there's not as much of a short-term upside with Disney, and maybe there's not as much of a long-term upside with Disney. However, I believe that there is. I think that the fact that just getting back to their all-time highs, you're looking at near a 70% return. That's insane for a company like Disney that I don't think is going to have any issue weathering this storm, at least making it through the other side. And there'll be bumps. But right now, Disney is trading at about $90. My personal buy-in price is at $86. So I'm looking to keep adding as it goes down. And the P ratio is 16s. So, pretty average valued company. And I think Disney's way above average within the market. Their debt to asset ratio is only 48%, which looks great to me, especially with a company with so much cash and so much staying power. They have a dividend. It's only at 1.8%, which is nothing to write home about. But that dividend safety score is at 37%, which basically that's the percentage of their earnings that they pay out in dividends. So that's a really safe one. Generally you want it to be under 75%, and 37%. They're not going to get rid of that dividend short term even, I don't think. So that's really great. And that's a dividend stock that I'm definitely adding right now. Now, again, keep in mind, they've been hurt a lot lately because of the parks and because of the cruises and because of loss of, movies showing in theaters. And all that revenue definitely hurts them. But I think that they're diversified enough with streaming, and they have enough cash and enough of a good brand that they're going to be able to make it long term. I don't see Disney going anywhere, and that's why that's the travel and leisure stock that I'm buying the most of. And so again, keep in mind, guys, don't just go out and buy these stocks. Do your own research. I hope this gives you a couple ideas on what to look for in companies that are struggling right now as far as, will they be able to make it to the other side? Are they good long-term investments? And also, I really just hope this gets you in the mode of wanting to invest, because it's really important, and no time is it more important and more advantageous than when you're in a down market. When it's scary to invest, like right now, as long as you have an emergency fund in place, and if you don't know what that is, check out my other video on it, but you need to make sure that you're safe and that you're stable economically. As long as you are and you have extra money that you don't need over the next 3 to 5 years or more, then I highly encourage you to start investing. If you want, there'll be a link in the description box down below, both for Webull and for Robinhood. Those are two stock trading brokers that I use. They have really good mobile apps. Both of them will give you free stocks. Right now, Webull is giving you 2 free stocks if you use the link below, one when you sign up for the account and a second when you deposit $100 or more. So definitely check those out. I also have a video walking you through the Webull app if you have any confusion. And I just really want you guys to start investing. I want you to take advantage of this, because this could be the opportunity of a lifetime to, make money right now while everything is on sale effectively. And while I really hope that everyone's safe in this time and healthy, don't let this pass you by. You're at home, hopefully, and you have time to look, to research, and to be buying stocks. Thank you guys for watching. Let me know what stocks you're buying down below in the travel and leisure section, or just in general. I'll be doing a couple more of these because I know people are really interested in wanting to know what other people are buying, what other people see as good values in the market right now. And with that, I really appreciate you guys watching the video. Make sure to like the video, share it with anyone you know might be interested in this, and don't forget to subscribe to the channel, because I'm doing weekly videos on personal finance, investing, budgeting, anything under the sun that falls under the finance sphere or the engineering sphere. I'll be talking about it. And with that, I will see you guys next time.